Welcome to our first truly complicated topic, accruals. I'm going to do my best to explain this as simply as I possibly can, but it's a little bit tough. You see, accounting can actually record transactions where these two kind of things don't happen. See, one, cash doesn't always have to change hands for accounting to make it a transaction. And two, work doesn't always have to be done for it to be a transaction either. That's what creates accruals. When one, cash doesn't change hand, or work is not done yet. That's the basis of accruals. Now I know that seems simple, but don't worry, it gets a little bit more intense. Accounting doesn't need both cash to change hand and work to be done in order to be called a transaction. Just one of those two options. For example, let's say I own a lawn mowing company, and I actually mowed your lawn today, but you didn't pay me for it yet. You see, you pay me once a month, something like that, and I come mow your lawn twice or something of that nature. Some kind of contract we have built in. You see, since I've actually done the work, but you haven't paid me for it yet, that creates what's called an accrual account. And this specific accrual account is called Accounts Receivables, because I'm expecting to receive money from you in the future. That makes it an example of an accrual account because one, the cash has not changed hands yet. But two, I actually did do the work, so it qualifies. The opposite of that is also true. So say I own a land mowing company again, and this time I've actually not done the work yet, but you've already paid me. So you gave me $100 and I'm gonna mow your lawn, say next Tuesday. Because of that, that creates what's called another accrual account. This accrual account is unearned revenue. And they have two different types of kind of impacts on the balance sheet, which we'll cover later. But for right now, you have to remember one thing. Accrual accounting allows accountants to record transactions that have not had both cash and work occur. So anytime that cash doesn't change hands, but work has already been done, that creates an accrual account. And anytime that work hasn't been done, but cash has changed hands, that also creates an accrual account. If both those things occur simultaneously, for example, you're at the grocery store and you buy a loaf of bread for $5, you swipe your card and you're good to go, that's called cash accounting. And you see, while the differences are very subtle, they're very important for large corporations. For example, large corporations have a lot of orders with companies that they haven't really paid for yet, or have paid for but haven't received the orders at this point in time. That creates these accrual accounts. Smaller companies like t-shirt manufacturers and just random kind of grocers, they actually are able to operate completely on cash accounting, no problem. But big companies like Walmart, Amazon, Microsoft, those companies operate off accrual accounting because it has such a complicated impact on their balance sheet and the way that they operate their business. For now, let's remember, accrual accounting is a little bit more complicated than cash accounting, but it's very important. To become an accrual, you either one, have to change hands with cash, but have no work done, or two, have work done, but no cash changes hands. If both cash changes hands and work is done, then that's called cash accounting.